Honestly, how did you make it this far in life without knowing this? You use money, you see prices go up, and you're hearing people talking about interest rates. And you just nod along as if you understand, don't you? Well, today, I'll explain how the Federal Reserve works to you like you're 5 years old. And by the end of this, you'll finally understand the mysterious group of adults who are basically in charge of the country's piggy bank. And you might even be able to explain why a carton of eggs suddenly costs as much as a movie ticket. So, let's start with the absolute basics. The Federal Reserve, or the Fed as its friends like to call it, is the bank of all the other banks. I mean, you have a bank, right? A place where you put your money so you don't have to keep it under your mattress? Well, your bank also has a bank, a much bigger, more important bank. And that bank's bank is the Federal Reserve. It's the head grown-up in the room full of financial toddlers. And its main job, when you boil it all down, is to make sure that the US economy doesn't fly off the rails. I mean, it's the playground monitor for money, making sure that nobody's pushing anyone else off the financial swings and that the whole system doesn't have a complete meltdown. So, how does this super bank for banks actually do its job? Well, it doesn't have a giant vault filled with gold coins like in the movies. Its power comes from controlling one very important thing: the cost of borrowing money. The Fed is in charge of setting the price tag on money itself, and this is its number one superpower. The main tool it uses is something called interest rates. And don't let that term scare you. It's incredibly simple. Think about it like this. You want to borrow your friend's shiny new toy truck, and your friend says, "Okay, but when you give it back tomorrow, you also have to give me one of your cookies." Now, the Fed tells all the big banks how many cookies they have to pay each other to borrow money overnight, and that is the most important interest rate of all. I mean, why should you care how many cookies banks are trading? Well, because it affects you directly. If the Fed says that banks have to pay a lot of cookies to borrow from each other, then your bank is going to turn around and charge you even more cookies to borrow from them. And suddenly, the loan for that car you want is much more expensive, and the mortgage for that house you can't afford is even more expensive. Your credit card debt gets more expensive, and the Feds make borrowing money more expensive on purpose when it wants people to stop spending so much money. It's like a parent taking away the video game because everyone is getting too hyper. On the other hand though, if the economy is sleepy and nobody is spending money, then the Fed will do the exact opposite. It will announce, "Hey banks, borrowing is practically free now. You only have to give back half a cookie crumb." So the banks, being very excited about cheap money, will turn to you and say, "Hey, want a car loan, a mortgage? It's super cheap right now." And this encourages not only you, but everyone else to go out, borrow money, and buy things. This is supposed to wake the economy up. So when you hear on the news that the Fed raised interest rates, all it means is that borrowing money just got more expensive for everyone, starting with the banks. When they say the Fed cut interest rates, it means borrowing just got cheaper. And that's it. I mean, that's the biggest part of their job. They're constantly fiddling with the price of cookies to either slow us down or speed us up. It's a surprisingly simple idea, which is why so many people in suits pretend it's deeply complex. Now, let's talk about the Fed's two big jobs, its main mission in life. This is called the dual mandate, which is just a fancy way of saying it has to do two things at once. First, it has to keep prices stable. Second, it has to aim for maximum employment. Let's break that down for a 5-year-old. Keeping prices stable means fighting something called inflation. Inflation is when your money becomes weaker. It's when your $5 allowance used to buy you a whole bag of candy, but now it only buys you 2 pieces of candy. The candy didn't get better, your money simply just got worse. And the Fed hates this. Its goal is to keep inflation low and predictable, around 2% a year. A little bit of inflation is considered healthy, like a kid who's growing slowly, but when prices start rising too fast, the Fed gets worried. To fight this, it does what we just talked about. It raises up interest rates. It makes borrowing money more expensive so that people and businesses stop buying so much stuff, which gives prices a chance to cool down. The Fed's second job, maximum employment, means it tries to create conditions where as many people as possible have jobs. When lots of people are out of work, the economy is sad and sick. And people without jobs don't buy things, which means businesses don't make money, and then they might have to lay off even more people. It's a very sad downward spiral. So to fight this, the Fed usually does the exact opposite. It lowers interest rates. It makes borrowing money cheap to encourage businesses to expand and hire more workers, and for people to go out and spend. But here's the tricky part. I mean, can you see how these two jobs might be fighting each other? It's like trying to pat your head and rub your stomach at the same time. If the Fed lowers the interest rates to help more people get jobs, well, all that extra spending can cause inflation to go up. And if it raises interest rates to fight inflation, then it could slowly down the economy so much that businesses stop hiring and people might lose their jobs. The Fed is constantly trying to find that perfect balance. It's a very, very delicate tightrope walk. They have a big meeting about 8 times a year where a group of serious-looking people sit around a table and argue about whether to raise, lower, or keep the cookie price the same. They look at a ton of data, they make their best guess, and they hope that they don't mess it up. And a lot of the time, it's really just an educated guess. But sometimes, just changing the interest rate simply isn't enough. When the economy is really, really sick, like it was back in 2008, the Fed has to pull out its emergency tools. And one of these tools has a very scary name: quantitative easing. But again, it's simpler than it sounds. I mean, think of it as the Fed creating new money out of thin air to pump into the economy. It doesn't just print stacks of cash and drop them from a helicopter. Instead, the Fed uses this new digital money to buy things from banks, usually government bonds, which are just loans to the government. It's like the Fed walks up to your bank and says, "I see you have this official IOU from the government. I'll buy it from you for a whole bunch of brand new money." And suddenly, your bank is flush with cash that it didn't have before. And with all this new money, the bank is supposed to feel safer and more willing to lend it out to people like you at a very cheap rate. It's the Fed's way of flooding the system with money to get things moving again. It's the ultimate break glass in case of emergency move. So, who are these people making all these huge decisions? Well, the Fed is designed to be independent from the government. The people in charge are appointed for long terms, so they're not supposed to be influenced by whichever politician is currently popular. The idea is to have experts focused on only the economy's wealth, not on winning the next election. Whether that actually works perfectly is a topic for another day, but the goal is to have a neutral referee for the money game. The Federal Reserve is broken up into a main board in Washington, D.C., and 12 regional banks spread across the country. These regional banks act as the Fed's eyes and ears, gathering information on what's happening in their local economies, from farming in the Midwest to tech in the West. This information helps the people at the big table make better decisions for the entire country, not just for the people on Wall Street. So, the Federal Reserve is the bank for banks. Its job is to keep the economy from having a tantrum, and it does this by controlling interest rates, which is just the price of borrowing money. Raising rates cools things down to fight rising prices. Lowering rates heats things up to help create jobs, and these two goals are often in conflict, so the Fed has to perform a constant balancing act. And when things get really bad, it has an emergency plan to pump new money into the system to prevent a total collapse. It's a group of so-called experts making educated guesses about how to steer a giant, complicated economic ship, and their decisions affect the price of your groceries, the cost of your car, and whether or not you have a job. But there you have it. The Federal Reserve isn't some shady organization performing dark magic. It's just the ultimate grown-up in charge of the country's money, using its tools to try and keep everything stable. It's a complicated job with a very simple goal: make sure the economy works for everyone. So, now you understand. You get it. The next time you hear someone mention the Fed, you can nod your head with the quiet confidence of a person who finally knows what they're talking about. So go on. You got this.